Right now, an unbelievable amount of wealth is moving through the global economy. Trillions of dollars are pouring directly into the technology sector at a breakneck pace. And all that money is funneling into a surprisingly small, elite group of tech giants. We are looking at the physical hardware, the silicon and processors, that has turned these specific companies into the market's undisputed leaders. The justification for this massive investment is visible everywhere. Artificial intelligence has rapidly woven itself into our routines, automating complex professional tasks and quietly powering the consumer tools we rely on every single day. Investors have watched this rapid adoption and concluded that AI represents an unstoppable technological march forward. The prevailing belief is that this sector will simply dominate the future economy without pause. On the surface, this level of total financial consensus feels perfect. It looks like a flawless, frictionless victory for the modern market. But if we look under the hood of these skyrocketing prices, a glaring anomaly appears. This diagram tracks two metrics. Down here is the slow, steady line of actual corporate earnings. Up above is a sharply accelerating, completely detached curve representing the stock price. The valuation is climbing exponentially faster than the real profits coming in. Because the broader global market has relied so heavily on these few inflated technology companies to drive growth, the entire structure is now highly concentrated and deeply vulnerable. So we have to ask, is this highly concentrated wealth the blueprint for a permanently changed economy? Or are we looking at the first predictable symptom of a devastating market trap? Market manias do not happen by accident. They are highly predictable psychological cycles that follow a strict mechanical pattern. Every bubble begins with stage 1, the spark. It always starts with a highly credible, mathematically sound, and genuine technological breakthrough. That breakthrough triggers stage 2, the rush. Early capital floods into the new space, and the first wave of investors sees massive payouts. Then the media steps in. Relentless coverage acts as an accelerant, broadcasting these early, massive victories to the general public. This brings us to stage 3, the mutation. The fear of missing out reaches a critical mass, and a wave of aggressive panic buying takes over as the herd rushes the gates. At this exact tipping point, the investor base completely abandons fundamental math and logic. The critical question driving the market changes entirely. People stop asking what a company is actually worth, and only ask how much higher the price can go. Momentum hijacks reality. What began as a legitimate technological invention is now a psychological trap. We have a precise historical blueprint for this exact scenario, the late 1990s dot-com bubble. Just like artificial intelligence, the early internet was a completely real technology that ultimately delivered on every one of its world-changing promises. This chart plots a major index over that period. Look at the jagged peak right before the year 2000. The technology was viable, but delusion pushed stock valuations to impossible levels. The verdict? Successful technology can still see its stock catastrophically collapse, destroying wealth. Let's return to our present-day AI giants. This screen displays major tech ticker symbols flashing in red, accompanied by stark negative numbers. This is what happens if their actual corporate growth slows down even slightly. Because of the extreme market concentration we established earlier, a localized failure in the tech sector will not stay contained to Silicon Valley. The shockwave travels instantly. A drop in tech directly hits the conservative, everyday retirement portfolios of millions of ordinary people. From there, it spreads outward, dragging down borderless global index funds that are tied to these massive market caps. A severe price drop doesn't mean these tech companies are failing. It means the broader market is violently adjusting its expectations back down to reality. When expectations become artificially inflated, they turn a minor corporate earnings miss into a massive global economic hazard. So how exactly do you navigate this? The first step to surviving a potential trap is to actively disconnect from the daily, localized hype machine. You have to enforce strict defense mechanisms. That means returning to long-term mathematical fundamentals and forcing your portfolio into rigid diversification, rather than chasing sudden momentum. Artificial intelligence will absolutely reshape our economy. But you have to ask whether today's extreme, sky-high prices have already completely priced in tomorrow's success. You are either witnessing the early foundation of a permanent, hyper-efficient economy or the absolute peak of a mathematical illusion. Your portfolio's survival depends entirely on knowing the difference.